Okay, guys, we need to talk about SVOL. YouTube has this new research tool where I can see what you guys are searching for, and this is one of the top results. And I think I understand why. The dividend yield right now is 18.26%. The history of the dividend is also pretty nice, consistent, although the age isn't that impressive. And as you would expect, in order to generate an 18% dividend yield, the strategy here is very nuanced. This generates the yield off of market volatility premium. Considering that juicy yield and the total return over the past 1 year, it can be a very tempting thing to buy, and it does have its use cases. And we're going to see exactly what those use cases are, as well as all of the potential risk and downside associated with this very complicated and unique investment choice. So I hope you guys enjoy the video. If you do, a like, subscribe, always greatly appreciated. And let's get into this. All right, so let's dive right into this, beginning with the fact sheet. And this right here is the overview page. Let's read some of this. So SVOL seeks to provide investment results before fees and expenses. By the way, what is the expense ratio? Okay, we have a gross expense ratio of 0.66. Not terrible, but also not great. So before these fees and expenses, the performance should correspond to approximately 1/5 to 3/10. Here's the decimal percentage of that. The inverse, that's why they're negative, of the performance of the VIX, which is a short-term futures index, while also seeking to mitigate extreme volatility. More on this later. Right, then this paragraph, they basically say why you might want this, and the gist is that it's an alternative source of income. And the final paragraph says that the fund's short fixed positions provides investors with optimized exposure for monetizing the premium in the VIX futures market. And then this final line has to do with the aforementioned mitigation strategy. So a modest option overlay budget is then deployed into the VIX call options to help protect against adverse moves in the VIX. This is a risky strategy, so they need something to help mitigate that. We're going to look at the price in a second. This does seem to help, but don't be confused. There's still a ton of risk involved with this strategy. All right, so now let's evaluate the behavior of this fund. You're going to see here that the purple line is SVOL, blue is the S&P 500, and the VIX, the volatility measure, is this orange line. And remember, there's a lot going on here, but the core strategy at play is shorting the VIX with this correlation of -0.2 to -0.3. Okay, so first thing to note is the history of SVOL is extremely limited. It would have been great if the performance went back to pre-COVID. That would have allowed us to see the ETF really in its natural habitat, supposedly. During 2020, the VIX largely declined from its massive peak, although there was lots of spikes along the way, and it would have been interesting to see how the fund handled that situation. But working with what we have, again, SVOL is the purple color, and this includes the return from the dividend, by the way. So 2021 was a year of low volatility, as we can see here, with a good amount of upside capture in the market. And even with the dividend, SVOL did underperform the rest of the market during this time. And if we really zoom in here, during these small spikes in volatility, the performance of SVOL did have a dip, although the loss was pretty minimal. As we continue down the historical chart here, as volatility decreased, this is when SVOL did the best, as you would expect. Here we have a large spike in volatility. Large is a relative term. And again, we see the price of SVOL decrease during this time, but not super significantly. So maybe that option overlay strategy is helping to minimize the losses. Now, as we get into 2022, we had the first sustained increase in the VIX right here. And SVOL didn't handle that super well. That was followed by a crash in volatility, but unfortunately, SVOL did slightly recover during this, but there was an overall net loss during this time of both rising and falling volatility. And as we proceed through the history, we see the same pattern time and time again. Every time there's a spike in the VIX, SVOL goes down, although not to a significant degree. And according to this chart, in my interpretation, the best time to buy SVOL and to initiate a position is when volatility is high and you expect it to go down. After all, this fund shorts volatility to generate its income. So it's very vital to understand what SVOL is and not something like jepi. This is where you can get into trouble with this ETF in my opinion. If you stack it up against jepi over the past 1 year, you might look at it and say, okay, the total return is a little bit higher, the dividend is a little bit higher, it must be a better investment. But this is where I want to burst your bubble with a wall of very intimidating text. I can't read all of this because the video is going to become extremely boring, but I'll leave this link down below. It's a must read if you want to put any of your money into this fund. Okay, so the principal investment strategy. A lot of this we can skip over because we already read it, right? The performance approximately corresponds to 1/5 to 3/10 the inverse of the performance of short-term volatility futures index for a single day, not for any other period. There's a reason why this is bold. This fund is not intended to be a long-term investing strategy. It's to short the market during opportune times if you're looking for an alternative way to generate income. So it's for a very specific kind of investor, but let's continue reading a little bit here. In pursuing its investment objective, the fund primarily purchases or sells future contracts, call options, and put options on VIX futures. The fund will hold cash-like instruments, high-quality short-term fixed income securities. This is the collateral. The collateral may consist of 1, U.S. government securities such as bills, notes, bonds issued by U.S. Treasury, 2, money market funds, fixed income funds, corporate debt securities, and it goes on and on. This is a very complicated strategy. Here's more information on the option overlay strategy. Again, I would encourage you to read this, but I simply can't in this video. And then we finally get to all of the principal investment risk, and there are a lot of them. Everything from active management risk, borrowing risk, to what's down here, leverage risk and limited history risk. But the one I want to take the time to read in this video is the VIX futures risk. So VIX future contracts can be highly volatile, and the fund may experience sudden and large losses when buying, selling, or holding such instruments. You can lose all or a portion of your investment within a single day. A little bit further down, they say the market for VIX future contracts may fluctuate wildly based on a variety of factors, including changes in overall market movements, political and economic events, wars, active terrorism, natural disasters, including pandemics, changes in interest rates or inflation rates, aka this is a very sensitive, fragile fund. And then finally here it says, high volatility may have an adverse impact on the performance of the fund. An investor in any of the fund could potentially lose the full principal of his or her investment within a single day. And again, the time frame here is very important. This is not supposed to be used as a long-term thing, and they touch on that a little bit more here on this bullet point of short-term investment risk. And I promise this will be the final thing we read here because this is extremely boring. So it says here, investors holding shares of the fund over long-term periods may be subject to increased risk of loss. So based off of this, it seems like the longer you hold this investment, the more risky it becomes. If I continue, it says the fund is intended to be used only for short-term investment horizons. An investor in the fund can lose all or a substantial portion of his or her investment within a single day. The longer an investor's holding period in the fund, the greater the potential for loss. Okay, so shifting over to more of my opinion now. I know the monthly juicy yield of 18.26% is very enticing, and when you look at the history over the past year against the market, it does seem to be very compelling. But just understand that this is not the same thing as a long-term covered call high yield fund like jepi is. In their documents, they keep saying that a main reason to invest in SVOL for short time periods is because it's an alternative source of income, while other sources might be more difficult to come by. But this has changed recently. So of course, they're referencing the pre-2022 time period when equities were skyrocketing to the moon. Because of that, their yield was near all-time lows. And also during this time period, the federal funds rate was also near zero. So it was rather difficult to find yield anywhere else. And when the risk-free rate is so low, yielding 1.3%, then that forces people up the risk curve. And that's what we saw all in 2020, 2021, and back in that time period. But of course, since then, things have changed pretty dramatically. Now the federal funds rate is near 5%, so that's a risk-free return. Equity prices have come way down, and thus the yield of the stock markets begin to become more competitive as well. So that just changes the risk curve to look more like this. Treasury bills are way more attractive, and there's just less of a return and reason to venture down this path to something like SVOL. But of course, that is all just my opinion. I know SVOL is a very popular fund, so let me know your thoughts in the comments below. I'd be very interested to see your perspective and how you use this fund if you do choose to invest in it. If you're still watching and enjoyed, I appreciate a like, subscribe, and I'll see you guys in the next one.